it's a mystery?
It's not a mystery. It's not a mystery at all. It's just how it is. Due to I don't know if any of your viewers know this, but from your viewpoint, it's all fine and dandy.
All right, guys, welcome back to another video. Today, I actually have a local lender with me, one of the guys that help my clients to get financed so they can, so they can get their dream home. The reason why I wanted to make this video, though, is because I get calls every single week from people who see me on either YouTube or they find me on Facebook, and they start asking me questions about financing. Hey, what can I do with my credit? What do I need to get pre-approved? What do you think about this? What do you think about that? And obviously, those are questions that it's not my, my expertise. So I wanted to bring aaron.chick with me.
Hey everyone, my name is Aaron.chick. I work for Certainty Home Lending here in Savannah, Georgia. I am a preferred lender with Lewis, and I'm here to help you with any questions, any concerns you may have. I've been in the mortgage industry for about 2.5 years now. I've helped over 60 plus clients in my own name. So used to be an assistant. I've helped probably close to 1,000 being an assistant. So I know a little bit about everything when it comes to these
close to 1,000 as an assistant. Gee,
yeah.
that's a lot of deals right there. That's a lot of deals. Well, let's get to the point so the people, the people watching can start learning about finances. So the first question is, what do they need to have ready before calling a lender? Like even before, I know the first thing they do is just start looking on Zillow, but there is that point where they're saying, you know what, I need to get started with this. So what do you think people should have at least ready before they talk to a lender?
So it's a great question, Lewis. So first things first is you need to get pre-qualified before you even start looking on Zillow. We don't want you to start looking on Zillow and set expectations for a $4 million home when you can only afford $100,000. So typically what I say people need to have in order have documents in order to get qualified are things such as pay stubs. Typically a lender is going to ask for about 30 days worth of pay stubs. Maybe you're self-employed. With that self-employment, we're probably going to need 2 years of self-employment income. So 2 years of taxes. So we can prove, you make what you say you make. On top of that, we're going to need 2 months bank statements and a copy of your photo ID. Those are all of the generic documents we're going to need from you. So that helps you kind of get everything ready and sorted. So when you talk to us, you're not fumbling the bag and we're waiting around for a month for you to gather all that stuff.
Exactly. Now, let's say they're doing it together, if it's husband and wife, or if they have so would they require pretty much the documents from both parties?
Exactly.
The same exact thing?
Exactly. We're going to need it from both parties, husband and wife. Some husband and wife are husband and husband, or wife and wife, however they want to do it. They try to leave their other significant other off the loan. But I'd say go ahead and prepare both because maybe you guys can't qualify for that dream home with just one person. But yes, it is best for everyone to go ahead and get all that stuff put together so we can get the ball rolling once you give me a call.
How does it work when, because now that we said, now that you mentioned the person and the significant other, if the person has good credit, they call me, hey Bruno, I got 760, I know I can qualify, you show me a few homes and then we go from there. But they want to do it together and they tell me, well, my husband or my wife or whatever, their credit is not too good. So how does that work? Do you think I should just apply just myself, or can I use my wife as well?
So the first step I would typically say is let's just go ahead and get both of you to apply. Maybe your credit's not that great to you. Everyone has a different consideration of what they call good and bad credit. The minimum credit score on just a generic loan nowadays is a 580 credit score. Some people call that low, some people call that high. There people range everywhere in between. So I would say go ahead and both of you guys apply. So in the case that maybe one person's lower, we as loan officers, mortgage lenders, we have tactics and ways to figure out how to improve your credit if it is low. I have a system that I specifically have in my company has to where we can go in and play with each and every single individual loan, credit card, everything, and figure out where that balance needs to be in order to improve your credit. So maybe your credit comes in low. Maybe we can work on improving your credit, or maybe you can qualify with just one of you guys. Maybe we don't need both of you guys. So, each
Exactly.
person, I would advise go ahead and just applying, and then we'll kind of take it from there and figure out what we need to get you doing in order to get you on that path to home ownership.
Exactly. Now, so this next question basically goes, it came to my mind when I heard you talking about it, because typically when I'm dealing with like, a couple, maybe one of them pretty much meets all the criteria on the checklist, and then
Mhm.
maybe the other person have one piece missing. Let me give you an example. Let's say my wife got a new job. She don't have the 2 years of taxes. She
Mhm.
got excellent credit or whatever. But is there anything on that checklist that is negotiable in terms like, can you guys give them a waiver for whatever reason, or is it
It
like
wouldn't it
no?
wouldn't necessarily be a waiver. Each person's considered differently.
Okay.
If you're self-employed, typically we're going to need 2 years tax returns. There are exceptions. There's different loan products where you might only need one. It's a case by case basis, so I can't promise you that you only have 1 year and I can make it work for you.
Okay.
Everybody's a different scenario, but there are some where maybe if you're self-employed, you only need 1 year's tax returns. Most of the time, if you're a normal hourly, salary employee, W-2 employee, or you're hired under someone, we can make it work with just 1 year a lot of times, depending. If let's say you're 18 and this is your first job, you've only been working for a year, that's
Hmm.
probably not going to work for you because we can't prove you can even hold down a job longer than a year.
Exactly.
How are we going to know if you're going to pay us back over 30 years if we don't even know you can hold down a job for 1 year? So it's kind
Exactly.
of a case by case basis. But let's say you got college education. If you went to college, you didn't even have to graduate. As long as you have past schooling in college, we can use that as previous work history, and that can count as a year. So there's different scenarios for everyone. Just I would say give whoever your local mortgage lender is a call and see what they can do for your situation. They may not be able to help you, but they also may. So I'd say just give them a call and kind of let them take your scenario and advise you from there.
Exactly. And that's why I tell this to my clients, you can now have a conversation with your cousin, your uncle, about how they got financing, and then think that every single thing that happened to them applies to you. Oh, well, he did it, so I can do it too. You know, that's
Mhm.
how it is. Now, how about the Hispanic people, though? I get probably like 40% of the people that reach out to me, which,
Yeah.
look, man, I have no idea how they reach out to me because I have no advertisement in Spanish.
Hey,
I don't go to events of networking or anything like. I have no clue how, but almost 50% of the people that reach out to me are Hispanic people. And they ask me sometimes, "Hey, what if I only have a green card? Can I apply for a loan? What can I do? Can you help me out?" So, what do you have to say about that?
with a green card employee are citizens, non-citizens. As long as you have a green card, we can make it work, depending on your citizenship stats. And then if you're not American citizen, there's also what's called foreign international loans.
Mm,
Foreign international loans, we as a company don't do them, but we broker them out. So you can still call me. I can still set it up for you. With those, typically, if you're not an American citizen or have a green card to work here, anything of that nature, permanent resident alien, your status, you're just straight up, you're not an American citizen. Um, they have what's called the foreign international loan. These can get kind of costly. Typically, you're going to need at least 20 to 30% down. The
okay.
money does have to be in a U.S. bank. Um, and you're going to have at least a year's worth of payments in most scenarios just sitting in that bank. They're going to have to know that you can at least pay your mortgage for a year off of what you
Okay.
have sitting in that account. Plus, then they want to see that you have enough money coming in monthly to be able to support the mortgage usually twice over every month. So it's a little bit more difficult, but
It
it's
is.
but it's doable. If typically it's for clients that are doing pretty well in life, I would say. They're
Okay.
more so buying a second house in America rather than trying to buy their first home in America.
So I had two people that reached out to me this year telling me, and they're Hispanic, by the way. They don't have their documents or whatever. They reach out to me, tell me, hey, this is my situation. I have $200,000 saved. That
Yeah.
I've been saving money for 10 years. I've been saving money for 15 years, and I'm ready to
Mhm.
buy a home. And I'm
Yeah.
like, okay, well, all I need is the proof of funds or whatever. Oh no, I don't even have my money on the bank. I have it in my house. So I reached out to a few attorneys because they wanted me to find out about it. And all of the attorneys told me no. Like there is no way. We're not gonna have anybody coming in here with $200,000 cash.
Yeah. Yeah.
Nobody. I'm not gonna make none of my employees take that money to the bank. I'm not gonna hold any earnest money from those. Because they
Yeah.
they need evidence. Like you said, they need the money on a U.S. bank account. They need to know where the money came from. All of that stuff. And it's so
Ex-
risky. I had no clue about that, and all the attorneys told me like there is not a law that says that you're not allowed to purchase a home with cash, like with real cash.
mhm.
But it's just so dangerous. Like no attorney is gonna allow somebody to bring $300,000 cash, and then we're gonna have to count it on the table
Yeah.
20 times to make sure.
Well,
It's
they
crazy.
don't want to do that, because they're not going to know where the money came from.
Hmm.
For all they know, it's drug money, stolen money, printed money, someone printed it off in their garage. They don't know where that money came from. So they want to
Hmm.
make sure they're safe, the attorneys, at least in the state of Georgia, we're in an attorney state. You have to
Exactly.
use an attorney to close on any home here in the state of Georgia. So they don't want to be liable in case that money is bad money. They don't want to be liable for that bad transaction because now they got to get dragged into court in case it is. So that's
Exactly.
why it has to be in a bank. And for any of these foreign loans per se, they wouldn't be in a U.S. bank because let's say you default on the loan for whatever odd reason, they can at least go back to the bank and get that money back. Um,
Exactly. Exactly.
that's why they're so risky and they're so hard to get, and they have so many qualification things you have to do. Is because worst case scenario, you're not a U.S. citizen, so they can't take you to court for it. They can't charge you for anything here in the U.S. So they want to at least make sure they have some type of something they can get here in the United States, which if it's in U.S. bank, they can at least try to do that.
Hmm. And I've gotten complaints from my Hispanic clients because they get asked an extra few questions, like you said, for like if you're not an American citizen, there's another set of questions that they need to find out first.
Mm-hmm.
And some of them, I had an experience with a Cuban guy who he got mad. He called me back frustrated because he said, oh, they're maybe just being racist. Everything that I say, they always ask me for proof of it. They always ask me for a document to prove it. I'm like, well, that's how it is with everybody. Even if
That,
I'm
yeah,
Puerto Rican. Puerto Rican people are American
yeah,
citizens.
yeah.
Dude, the VA asked me for like, I don't know, like 80 documents, and I had to
Yeah.
do it.
It all falls down. And it's not us being racist. We don't care. And part of our application, you have to fill out what ethnicity you are, and that's not for you because we're going to give you some type of special treatment due to a certain race. It's for
Hmm.
the government solely to track to make sure we're not being racist. They look at every single loan we do, and they make sure we're not giving one race a better interest rate compared to another. So it's just how it is. Due to I don't know if any of your viewers know this, but '08 did happen. The '08 mortgage crash happened. Ever since then, it's just gotten more difficult. They want to make sure we're giving good loans, that people aren't going to default on loans, that any loan we give, they can actually qualify and they can give us and provide us the documentation to prove what they said. Because a lot of times back before '08, it was called statement loans. You just told the bank how much you made. They took it
Hmm.
at face value. They said, yeah, okay, that's fine. And then they give you a loan. Well, look what happened. Most of those people didn't make what they said they made, and it caused the whole economy to crash. So
Exactly.
we're not only asking you for 80 bajillion documents, we're asking everyone for all of those. So
Everyone.
so don't think it's just you. I know it's a pain in the butt, but it's just part of our job. And trust me, if we could not ask for them, we wouldn't. We just have to. It's made
Exactly. That only makes your job even easier.
yeah, it's just part of the government. They set the rules and we follow them.
How about the classic question of, well, I already have a pre-approval letter. I got it like 5 days ago, and now you're telling me that I can shop around. I don't want to do it because I don't want my credit to go down. How do
Yeah,
you? Is
yeah.
that true or no? Like I don't know how true it is or to what degree. How many points do you drop? it's a mystery?
So it's not a mystery. It's not a mystery at all. It's a myth that's going to hurt your credit. The credit bureaus actually recommend that you shop it out. They want you to make sure you get the best rate and deal. So what happens is you have usually about a 60-day window to shop out your pre-approval letter or your rate, your closing cost, whatever it is, whatever you're trying to get cheaper, better. They want you to shop it out. Just like whenever you go apply for a car, for instance, you have on a car, you have, I believe it's 30 days to shop it out because they want to make sure you get the best deal on your car. So what happens is every time you apply, yes, you're going to take a credit hit right there in that moment. It's usually only a couple points, 3 to, let's say, in the worst case scenario, I've seen it be 8 because the person just didn't have a lengthy credit per se. They've only had credit for like a year or two. So yeah, every time they get a credit pull, it's going to hurt them a little bit. But it's going to, every single time, it's going to hit you right then. But then in about 90 to 120 days, every single one of those credit pulls are all just going to combine into one. So you're realistically, yes, in that exact moment, you're going to see a couple hits on your points for every time they run it. But then in the long run, it's all going to end up being just one big time, one big hit, one circumstance. Because realistically, you're probably only going to buy a house through one lender. For most people, they're not going to buy 3 homes at one time. So it's all going to be one at the end of the day. So don't worry about checking in and applying to different places because at the end of the day, it's all going to end up being one. And it shouldn't hurt you that bad being from, let's say, a 720 to a 715. You're still probably going to get the same exact interest rate. So it's really not that big of a deal. It's recommended. And I'd say, ask the questions to every lender. What are my closing costs, down payment, interest rate, monthly payment, everything of that nature, and then have them send a breakdown sheet because some lenders out there, they'll hide fees. I'm not going to name any lenders by name, but a lot of those big ones you see on TV, they'll have hidden fees that they're not going to disclose to you. And if you talk to your local lender, they'll explain exactly where those fees are being hidden.
What is the difference between a mortgage officer and a mortgage broker? Like somebody who tells me, "Hey, I am a mortgage broker."
It's relatively the same thing.
Same thing.
We all call ourselves different names. Every company has a different way to title it. It's just a fancy name of being a lender in essence. Everyone
So
calls
there's nothing they can do that another person that calls themselves.
Not necessarily, no.
Yeah.
We pretty much all do the same things. Maybe some mortgage, there can be a difference between a mortgage broker and, let's say, a loan officer or a mortgage lender. And that's just because they work through many different banks. But I'm a loan officer and I can work through many different banks as well. So it's here or there. It more so matters about how the company wants to define it.
All right. So I got another question for you. How about the down payments? I think a lot of people get confused between closing costs and down payment, and they get surprised. I'm telling you, I've had people under contract thinking, "Oh, so it's not the same thing." I'm like, "No, I've already had this conversation with you," but they always thought it was like another way of saying closing costs.
So down payment and closing costs are 2 completely separate things, and I'm glad you brought up the closing costs because I was going to go into that as well. So down payment is solely as money you're putting down towards the house. So you're buying a house at $100,000. Typical minimum down payment is going to be anywhere from 3.5% to 5%. So you're buying a house at, let's say, $100,000. You're putting down the minimum 5%. You're putting $5,000 towards the equity of your house per se. You already have paid off $5,000 of this $100,000 home. Closing costs are solely going to me as your lender. We're getting our fee for doing your loan. So
pretty much you're paying for the service, basically.
Yes. So you're going to have what we charge the lender. My company fees are typically only about roughly $1,000 from our side. But then you have in the state of Georgia, you have to use an attorney. So the attorneys charge their fees. Attorney's fees can be anywhere from, let's say, $1,000 to $5,000. It goes off of the sales price of the house is how they charge it. And then you also have money, some of that money from your closing costs going to set up what's called an escrow account. For people who may not know, an escrow account is where we take a little bit of every single monthly payment and we put it into a separate account to where we can make sure your taxes and insurance are paid on your house every year. Because we want to make sure your taxes are paid so the government can't come in and take the house out from underneath you, because then we lose out on all the money we're supposed to get and paid back from you. Mm-hmm. And B, we want to make sure the insurance gets paid because God forbid your house burns down or a tornado hits it or a hurricane comes. We want to make sure we can at least build your house again of the same exact value. So that's where that escrow comes in. That's usually where most of your closing costs comes in. It's a setup for that account to make sure that your monthly payment's not going to be extraordinarily high, so we can have that escrow payment be made at the end of the year.
Exactly. Pretty much it's just like when you're unemployed and they take your taxes from you. They know, the government knows, like, if they don't do that, people ain't gonna pay it.
Yeah, exactly.
They'd rather just take that out of their paycheck to make sure, hey, I know this guy, I don't have to worry about next year on tax season chasing this guy down. So it is basically the same concept. So
and then to go in on it, so that was me touching over closing costs per se. Another question you had, the first question you had was down payment. The typical down payment, as I said before, is usually anywhere from 3.5% to 5%. That's the minimum. So 3.5% for like a FHA loan per se, which we can go into loan types if you want. But 3.5% for there, and then you have 5% for conventional loans, and then you can get down payment assistant loans. You can get USDA loans, which are zero money down loans. There's all different type of loan products that your lender can figure out what's the best situation for you and your circumstance. So it's usually my go-to. It's a 3.5% to 5%, and then the closing costs on top, I usually say another 3 to 5%, give or take. And the way to kind of play that out is, if you're buying towards the end of the year, those closing costs are probably going to be closer to a 5%. If you're buying at the beginning of the year, you're probably closer to a 3%, just the way taxes work out with those. So
exactly, because they're going to need more taxes from you for the following cycle.
Yep.
How about what if I'm just trying to buy an investment property? Because you mentioned down payment, it's anywhere from 3.5 to 5% minimum.
Yes.
Is that only for people who want to be, primary residents or investors?
That is only for a primary residence. That 3.5 to 5%. If you're looking for an investment home, the minimum is 15%. But with that 15% is going to get you a terrible interest rate. So that's not going to help with your ROI on your investment home. So I would typically recommend you're putting down at least 25% on a investment property, so you can at least get a better interest rate and help your ROI. Because at that 15%, you're usually paying discount points, which discount points are just points to even get you on the rate sheet. You can either use them to buy down your rate, but in a 15% investment home situation currently in 2022, November of 2022, you're paying discount points just to get on the rate sheet at a 15% down payment in an investment home. So
what if I got a question about something that is happening right now with a client? Well, it happened. We already solved it. She's going through the financing with the builder's preferred lender or whatever, their own company. And we had a situation. So she was a homeowner.
Yeah.
She didn't want to sell their home. She's like, no, I want to keep it as a rental, but I'm getting my home built, so it's not like I can move out yet, right? So the lender was requesting from her to find a tenant. Like, hey, you need to find a tenant. We need to do the numbers. How much are you going to rent it for? Because we're going to use that towards your income. Is that like, does your company deal with things like that? Like, if I'm a homeowner and I just want to transition from one home to another, but I don't want to sell mine, because that affects the debt to income ratio.
Yes, that's what I was going to bring up. Every mortgage company is going to deal with that exact issue. So what that plays into is you're only allowed per loan. Every loan type has a different debt to income ratio. Ultimately, what a debt to income ratio is it's the amount of monthly income you make versus the amount of monthly debts you have. For instance, I'll just use a generic rule of thumb, 45%. So you can't have 45% of your income going directly to paying debts every month. Usually you don't want to go above that. So what in that situation, what may be happening is they can't have that mortgage on her liability side. They can't account for her paying that debt and getting this new house, her old mortgage. So they need to know how much she's renting that house out so they can deduct that liability off of her so she can afford this new house. And she may be in a situation to where most people are. Whenever you're buying that next house, we can't use your full monthly rent until you have 2 years of previous rental income. So in that
I didn't know that. You see, that's a detail that I didn't even know that. So you mean on the new, okay, I have this house. If I were to move out of here and I say, hey, don't worry about it, I keep it as a rental. So you guys require, not that required. You say you guys don't count it completely as income until you have at least 2 years of evidence?
No, so we can't count the full 100% of that rental. We can only use 75% of that lease to offset that debt. So let's say your mortgage is, for instance, $1,000. You're renting out the house for $1,000. You're covering your mortgage. So from your viewpoint, that's all fine and dandy. We have to account for at some point over the next 30 years, you're going to have a vacancy. So we call it a 25% vacancy rule. We have to go ahead and account that you're going to have that house vacant for 25% of the time. So that $1,000, we're now only counting $750. So there's a $250 gap there now that we have to go ahead and just account for. So that's why they want to know how much she's renting it out for, because she doesn't have 2 years of history yet. And they have to know how much debt they may or may not have to throw into her liabilities to figure out if she still qualifies for that home or not. If she's that type.
That's interesting. Damn, I didn't even know that thing.
Yeah. That's it's little details, little things that most people don't know about, but this is things we deal with on the day-to-day that people they don't see on TikTok or the YouTubes.
Exactly.
They're not talking to the real professionals. They just saw Joe Schmo on YouTube tell them, hey, here's a life hack, go buy a house with an FHA loan and rent it out and get another one.
And they talk to their uncle at the Christmas party. Oh, well, I rented my house and just bought another one. And then you think you can do the same thing.
Yeah, they don't give you all the details. Yes, you can do that, but there's some minor details there that you gotta uncover. So
Exactly. Well, that's it for now, guys. I'm gonna be bringing aaron.chick again to answer more questions that you guys have. And actually, if you guys have any other question, just put it in the comments. We would like to answer every single questions. Because guess what? I can use this in video, send it to people. That way they can have like an orientation.
Perfect.
So
perfect.
Where they can reach you? I'm gonna put it on the down below anyway, but just tell them your Facebook, whatever, Instagram, phone number, whatever.
Yep. So best way to contact me is I'd say shoot me a text or give me a call. My cell phone number is 912-445-1544. Feel free to reach out. Sometimes I'm a busy person. I can't always get back to you, but I usually get back to people within 48 business hours.